Good morning, my stock trading peeps. It is Friday morning, 11:01. That's exactly the time that I do these videos here. So, looking at where we're at for today, I've just run the spreadsheet. 32,449 Dow. So here's the XLP. Um, not breaking out to new highs, but just consolidating back into a 1.0 pattern, with a little bit of trimming going on. Not a lot of trimming, just 0.004 of trimming. So somebody's in there just doing a little bit of trimming as it's had its little bit of run. That's all normal and natural, exactly what we'd want to see. XLE did spike to 93.02. Remember that spike from yesterday's video? I said look out for 93.22. I don't know how fast the spike's going to happen, but it happened very, very quickly. Very, very fast. Because everybody's back to work and everybody's driving their car and everybody's burning through gasoline, and we don't have any capacity to be able to produce more gasoline. The last capacity that we ever had, or the last refinery that we ever built in the United States, was 1970. Those are getting to be very, very old, and they're going boom. That's what happened to the one in Oregon, Ohio. It got just so darn old it went boom. And that's what will happen to all of them eventually if we don't start taking care of this stuff. So oil, long oil, long oil, long oil, it has been a great play. Short tech, short tech, short tech has been a great play. And if you actually look at both charts and put them side by side or overlap them, long oil has now met up with short tech. They are now running cohesively together. Tech had exploded higher and oil had exploded lower, and now they're actually both together. So what do you expect that to happen? You expect tech to go down and you expect oil to go up, which is exactly what we're seeing today. Oil up 92.40. That's all good. XLU, utilities sector. Again, people are moving to the safety of utilities. In this downward sloping tech market, people are selling their tech. They're hesitant to buy oil because the press hates oil and the administration hates oil. So people are having a very hard time going long oil. But that's okay for us because eventually everybody will go long oil because they'll recognize that that's the place to be. And so people are putting long utilities. It's a different way. The unfortunate thing is utilities are highly leveraged to interest rates, and interest rates are soaring. XLK, the tech sector, notice the blue there in our chart. Now, yeah, today we did have a little bit of a relief rally in tech, but the data sets actually went down. Look at 0.8308, 8276. We have lower to go in tech than 118.82. We will be going lower in tech than 118.82 on the index. It's a great time on this little bump, I believe, to be shorting tech still. There's no difference in the trade there. Nothing has changed. XLB, materials. Again, people are selling their tech and they're going someplace and they're saying, hey, if we're going to go to electrification, if we're going to do this, then all of these minerals should be really, really good place to be. And you're seeing that. You're seeing money move there. But it's a topsy-turvy thing. $75.92 is an all-time high for the XLB. So was that successful? Sure, it was successful. Okay, good. But notice how 75.47 and 75.92 were pretty much to the top end of that trade, I believe. And notice how the market, it's all green, but notice how weak this is. This 90.11 here. You just can't go there. This should all be red. Let's get that fixed. Should all be red. I have to do this by hand, so. And this should be green. So let's get this green. Yes, there's some kind of a rally going on, but I would be shorting minerals here. Nothing has changed. XLY, the consumer, As we know, the consumer is getting crushed. When they raise interest rates, the consumer gets crushed. And as we know, we still have further to go down on this. 139.75 was a little bit of a relief rally today, and 1.0243. But the trend is still lower. And look at, again, its data sets, 8307 to 8283. Yes, it's got a little relief rally, but the internal data sets are actually worse because people are selling more of this than anything else. That's the sector that they're selling. XL, you have to do the homework on the stocks in the sector. I can't follow all of the stocks all the time. XLC, communications, as I said, communications, get the heck out of them. When I was over at my TELUS store talking to Tamara at the Tecumseh Road store, who's awesome, and buying a new Apple phone because mine had gone 2 years and I have to go over and exchange something that's perfectly fine. The people in the TELUS store were coming in with their pennies, nickels, and dimes and throwing them down on the counter and saying, please pay my bill because I'm all out of money. Nobody's paying their bill. I would highly suggest at this point in time that XLC shorting by this time next year, that's probably going to be down to 40. We'll see what happens with that, but that's what my belief is at the very least, and this is my video. Here is the banking sector. Again, the banking sector is moving up, 34. Why? Because the banking sector, if you put your money at the bank, they're going to pay you 0.5. And then they're going to go and take that same dollar that you just put at the bank and they're going to give that to the Federal Reserve where they're going to earn 3.9. So they're making 3.4 on your money. It's a great time to be a banker, and there's no risk to unless the U.S. defaults, there's no risk on the money that they put at the Federal Reserve, and that's why every foreign bank is taking all of their dollars and they're moving them. There's over $2.2 trillion now on deposit at the Federal Reserve Bank, earning 3.9%. How Americans are paying 3.9% on $2.2 trillion, I don't know. Seems like a train wreck to me. Especially if we're going to be going into a recession. That's why they want to raise corporate taxes on everybody as well, too. That's why Canada is raising corporate taxes. They're like, geez, in order to continue to keep spending like drunken sailors like we have been, we need to get tax money from someplace. Hello, corporations. We're going to get the money from you. You're mean and nasty. You employ us, but you're still mean and nasty. So XLV, healthcare sector, again, it's breaking out of its trend. Notice that there. Sorry, my camera's a little bit out of focus. 9995. Okay, it's a week out of trend, and it can come back into trend, but we'll have to see. It's a little epic battle going on in the hospital sector because nobody's paying their bill. And industrials, we are onshoring everything. That's what the employment numbers today showed you. The employment numbers today showed you that people are getting laid off in the tech sector, but who cares about most of them? Most of those folks, that's kind of mean and nasty to say it that way in case you're in the tech sector, but you'll be fine. You've got other things that you can go do. You have other skill sets that you can go use. You can open up your own firm and make your own money. You don't have to work for Google, Apple, or any of those other people because your skill sets are such great skill sets that you can go make money in all kinds of different ways. I could use your help. I could just pay you $1,000 for every real estate transaction, and you could become rich because I could do a lot of real estate transactions with the right tech people. It's impossible. Let me put it that way. It's impossible to find the right tech people in the real estate business. It's just impossible. I've been looking for the last 8-9 years and I haven't found them yet. Where are they? I have no clue. So anyway, then we're sitting here 1.00, 1.00 if we follow along my cursor there at the end of the screen. But notice this, 0.8341 yesterday, 0.8336 today. The market's actually weaker today, even though it's up 500 points. If you do the math, we're calling for a little bit of a decrease, less than 1%. But also notice that we printed 0.9795, 0.9785 for the first time ever. We've printed two blues, which is a consolidation trend. And we've never done that. Okay? So this is interesting data sets. At the end of the day, it's a very interesting data set. That tells us that there's something lower coming at some point in time. That tells us that people are transitioning away from what used to work to something else. We can see where they're transitioning their money to. We know that everybody now is turning long oil because that's the only place where there's going to be any gains to be had. Long oil, or long energy, let's put it that way, because the XLE is actually an energy index. So that's natural gas and all kinds of different things in the XLE, but the biggest players are more oil driven, even though ExxonMobil gets a lot of its revenue from natural gas, Chevron gets a lot of its revenue from natural gas, and natural gas historically will start moving up in the United States of America. What the question is will a natural gas go to $20 a cubic foot like what it is over in Europe right now? Right now, natural gas in the United States, where we produce most of our electricity, is currently $6.70. So the question is, do we get to parity with what's going on in Europe? I don't think so. That would be a terrible day. But it would be really, really good for our energy long, but it would be very, very bad for human beings. So we'll have to see what happens with that. It's an epic struggle that's going on in the market here today. So I would be trimming, and that's what I've been doing in my own personal account. If I pulled up my own personal account here, let me put the camera down for a second. Do enjoy this time for just